My name is Charles Brown III, aka CB3. I'm a portfolio manager and financial educator, and I've been an investor for more than 30 years. As a portfolio manager, it's my job to keep our clients calm during difficult market periods. I did it in the crash of 2008. I did it in 2009 and 10 as a commentator for Fox News. And I did it in 2018 during the trade war scare. But 2020 was different. The pandemic brought a new intensity of uncertainty to all of us. When I began researching this week's show, I asked, how can I encourage them financially this week? How can I help them make their week more successful? That's why CB3 Live exists. We've been on 2 platforms in 2 cities with the goal of providing financial truth and a sense of calm about what's happening right now. Every week, I look forward to providing financial peace of mind to my clients and listeners. It's for this reason that it's a privilege every single time I start a broadcast by saying, from COVID, U.S. policy, and world economics to clarity. This is CB3 Live. Good evening, everyone. Live from Nashville. It's Thursday, March 25th. I'm Charles Brown, Portfolio Manager with CB3 Financial. We're so glad you are with us tonight. Just like the opening video said, I'm an investor just like you guys. I am a portfolio manager and, of course, financial educator. But in the end, I'm an investor and I have the same goals and dreams that you guys do. And that's why I do this program. Because I want to bring you peace of mind and I want to give you some financial clarity. Remember, clarity, okay? If you can get that on the screen there. I got this gift last week and it reminds me that I need to bring you guys clarity. So I'm going to do that. The 2 questions I ask myself every week are, how can I encourage you? And how can I help you be more financially successful? And that's what I aim to do. So the COVID aftermath, we're going to start talking less and less about the medicine and the actual financial impact and ask if we're ready for the second quarter because we're winding down here in the first quarter. For you guys that are new, be sure that you go to YouTube. If you're there watching it, you're already there. And subscribe to me, okay? And then click the little bell so you get the updates when we go live. Also follow me on Twitter. I tweet every single day, sometimes twice a day. And you can also follow me on Facebook and LinkedIn. Those of you that are new to the program, we cover the news through COVID, U.S. policy, and the world economy. And I actually have 2 emails this week from people who have listened, and I'm going to read the first one now and the second one near the end of the program. But this one is basically some feedback, just in case you think I always get really positive, upbeat feedback. This was good, but it wasn't something I was expecting. So your instincts about asking about politicization of your show are on target. The political opening was disappointing, not sufficiently and tightly tied to investment returns to spend your nor our valuable time on. In almost any capitalistic economy around the world, even economies with many more social benefits than ours, investors make good returns. Even in this economy, there are opportunities and investment advisors are responsible to find them. Investment advisors have little input to policy and policy decisions and developments, so why would you spend time on that unless you're tying it to an explanation of why you made a particular investment? Okay, that's a fair set of questions, and here's my response to that. CB3 does, in fact, have very little input on U.S. policy. However, U.S. policy has a tremendous input on our investment decisions, and thus I must better understand policy trends and influences. And I will contest earlier that economies around the world have as good a returns as we do in the U.S. That's just simply not true, certainly for the last year. Nonetheless, I don't want to sound defensive. I appreciated that. Anytime you guys want to write, it's cb3@cb3.com, and I would welcome your input, okay? So the first topic is COVID. And again, we're not so much talking about the medical impact here, but the aftermath. And this is a story that I found discouraging, but it's just something I need to tell you guys about. This is the Yankee Candle Village. So you know what Yankee Candle is. This is one of their largest stores, and it is shutting down. 54 full-time employees affected, and plus all the financial relationships connected to them. So this impact to the village of Williamsburg is significant. And basically what's concerning me is that when large-scale government overreach happens in the name of public safety, the portfolio impact, and here we are with this new initiative. I'm going to try to have a portfolio impact on everything that I say, at least in the COVID and the policy section. The rest of them should be pretty obvious. But we lead with these two sections because these are largely aspects of society that are out of our control. As the writer so eloquently said, it is out of our control, but it does affect our decisions. And the portfolio impact here is that there's less opportunity to invest in American emerging entrepreneurial companies, and that's why I have to pay attention to that. Our second story in COVID is basically the disparity between how the Europeans are reacting to this COVID aftermath versus the Americans. Well, they're exhausted, okay? They're in the second year just like we are, but they have a lot more pessimism, at least what I'm reading, and resignation and just downright anger at their governments because of these ongoing shutdowns. The number of people that have been vaccinated is actually pretty astonishing. If you look at the chart here, look at the number of the U.S. So this is vaccination doses administered per 100 people. We're right at 38 per 100. So that's a pretty high number, way over the European Union and Japan. They're not even close. So most Asian countries have administered doses to less than 3% of their populations. So what's the portfolio impact? Well, Americans incentivized their pharma companies, and our American pharma companies provided. We invest by following success. Let me say that again. We invest by following success. I haven't seen much success in how Europe has handled this pandemic, certainly in the last 3 to 4 months. We have 3 vaccines in operation right now. You just saw on the previous chart the number of people that we're reaching, the number of Americans that are taking it. Again, you don't have to, it's there if you want to. And the success of American capitalism has placed us as the world leader in the post-COVID era. So when people ask why I'm not running to invest over in Europe and Asia, we do some investing there, but I am not impressed with how their economies are being handled in this post-COVID era, I should say. And that's how our portfolios are impacted by that. And the last topic here that I have for COVID is actually a story from one of our viewers. So let me go back, hit that twice. This is St. Andrew's College in Scotland. I believe this university is like 300 years, no, that's not right, 650 years old. And so this viewer said, this is just a story you might want to know, Charlie. My daughter, who's married to a man who's, which means that's his son-in-law, is attending this school. But basically, Dad, if you wanted to come over and visit, you'd have to come into the back door. We'd have to keep the blinds closed. You could be arrested for not quarantining. Now, this is a big problem. Imagine the money that's being spent to go to school here. I mean, you can see the fancy pictures of the school and everything. Again, 600-year-old school. I emailed this gentleman, and he responded back to me. Again, this is the son-in-law of my viewer. We're leaving Scotland earlier than we expected because the main library's closed, the graduation ceremony's canceled, all the classes, meetings, seminars are online, including my doctoral defenses. So I'm paying tens of thousands of dollars, and I've just run out of reasons to be here. So what's the portfolio impact? When it gets to the point that countries and higher education entities overreach on our personal liberties, that tells me that that country in the very next step could extend that overreach to the capitalism in their countries. That means Scotland, that means England, that means France, that means Germany. Most of those countries that I just mentioned certainly have an element of socialism in them. And it makes it less attractive if I think that those governments could extend their reach beyond education, which clearly affected this young man, and to the marketplace. And if I can't trust a government to allow personal liberties and freedom to exist by this, what I think is onerous overreach on the aftermath of COVID, then that affects our portfolio decisions. And I think you guys should know that, okay? All right. Let's see what we have here. This is the summary of what we just looked at. Small businesses in America are closing and getting crushed, reducing investment options. Europe is way behind the U.S. in both COVID testing and vaccines, reducing our incentive to invest in non-American pharma. And personal freedoms of Americans are being eroded. This Matt Voss case is not unique by any stretch of the imagination. Okay, second area. Policy. Now, I realize this can be a controversial issue, and based on the email that I got, it certainly, can rankle people the wrong way. But the reality is that U.S. policy definitely affects our investments. It begins with politics. Politics is the debate of our national and state leaders to create policy. Once policy is created, then it becomes the law of the land. But policy then affects us. It affects us at a personal level. It has personal impact, but in particular, for this program's point, it also has portfolio impact. And that's what we discuss on this program. So these chief executives, you probably saw this, were grilled today by the House. What is in play here is a law that was introduced in 1996, and this is called Section 230. So Section 230 has been very controversial. It was when Donald Trump was president. It continues to be. And interestingly, it rankles members on both sides of the aisle because they don't like the way that these big entities, social media companies, in their opinion, at least based on what I saw in the testimony today, handle this flippantly. So Section 30 basically says, again, 1996, that who is legally responsible for this content? Well, these media companies don't want to be responsible, so this law essentially gives them a shield. Well, it basically says that, it's the users that are responsible and not you. So they are shielded, if you will, from that. But this law also gives them a sword, pardon my little primitive graphics on the screen, all right, because it means that these entities can remove any material that they find objectionable, and it's solely at their discretion with their review committees at these companies. And that's how you saw the president and other people get locked out of Twitter and Facebook towards the end of December and early in January. So how does this have a portfolio impact? Well, the attractiveness of these companies and other media companies will change if Section 230 has a structural change. So yes, policy does have outcomes. We've invested in all of these companies at some point, but we really don't know what's going to happen here legislation-wise. And if Section 230 gives more exposure, if you will, to these companies for liability, we'll have to take a real strong look at that. Okay, the second story in policy here, and this is something we all know about, and it's only, I guess, been looked at from a political or social point of view, but I'm seeing now the mayor of Portland saying, we are tired of this. And this is someone that just did not do anything for months and months and months. But Ted Wheeler said in a news conference just this week, the rioters, this is a quote, are harming the cause of racial injustice and also standing on the air hose of our economic recovery. I really like that line, and that's why I ended up using this clip, standing on the air hose. So it kind of has that little choking insinuendo. Now that goes back to the Floyd situation in Minneapolis. People use incendiary language because they have frustrations and they're fed up. And again, I want to mention the specifics on this and how it affects us as investors. This one woman that was interviewed has two stores. So she has two chocolate shops. She had to close one of them, and the other one was shut down from March until November. And she's basically saying, I don't know how I'm going to survive. And her quote here is, "I believe in the right to peacefully protest. I don't believe in people stopping me from earning an income and for providing for my family. You just don't get to change from destruction." In other words, you can't get positive change from destruction. What's the portfolio impact? Well, there's a loss of attractiveness in investing in companies headquarters in states and cities that promote, pardon me, or allow policies of out-of-control social unrest. And there's just no other way I can come down on this. If I had a choice to invest in a company in Nashville, for instance, our area here, or Kentucky, Lexington, or even Colorado versus downtown Portland or downtown Seattle, it's going to give me pause if I think that there can be social unrest. Now, I understand that companies are global and obviously location-centric is not crucial, not the way it used to be. But we had a bomb here in Nashville on Christmas Day that knocked out AT&T service for 7 days. So obviously the assumption that some of us make, including me, that the infrastructure is safe from these kinds of events, is something that we have to really be careful about. So I just want to bring that to your attention. I think it's important. So the next story here basically is taking us to the world economy, okay? So the world economy is a complicated topic, so we break this down into 6 pieces. Those of you that have been watching the show see this. If you're new to the show, that's what we're doing here is we're looking at the weekly market review, our featured stock, economic indicators, which are what I use to basically make the decisions on buy and sell, how the Fed influences the U.S. housing market, and crypto, which has been an area of interest for many of you guys. So the weekly market review, as of yesterday, I'm always doing this 1 day late so I can get the closing data. This is way back from where it was earlier this year. The Russell was at one point up 23% for the year, just up 8 right now. The indices are positive, and we did have a little bit of gain today. But basically, you can see the NASDAQ less than 1% up for the year, and that's because of seasonal tendencies. And I do want to spend some time on this because I know there's some of you guys that you just hate it when your accounts go down. Well, I should be candid and say we all hate it when our accounts go down. So this is the CB3 program performance. Now, I put a summary of what the programs do here. Capital growth has actually turned negative for the year. Now, it turned back positive today, but I only show as of yesterday. Strategic growth, diversified growth, and growth in income. Those of you that have been watching the program for some time know that I am a portfolio manager. It's actually in the opening video too. These are the 4 programs we trade. These are programs that I've designed. These are programs that I trade for our retirement accounts, meaning our family accounts plus our family trust. We're a small family office, and our clients trade the same programs that we do in a slightly different blend. Everyone has their own level of risk. So obviously it's all segregated accounts. But I think it's important to realize that we track the market with these 4 programs, and they're unique to us. They're not something you can find anywhere else. Now, many of you have asked, well, what is your performance over a longer period of time? Well, we're very near the end of the first quarter, and as soon as the first quarter finishes, I'm going to provide that, and this is what it's going to look like when you see it in the next program. So on the April 8th program, you'll see 1 year, 3 year, and 5 year performance of our 4 programs and how that works, okay? And it'll give you a chance to, ask questions. So I want to just remind you, the most important quality for an investor is temperament and not intellect. The reason that Warren Buffett has the success that he has, and he has made some not great calls, he'll be the first to tell you, but his investment timeline is forever. That's his preferred timeline. Well, of course, that's our preferred timeline too. We've had some stocks that have been in our programs 2.5, 3 years. We have others that last 2 weeks because they disappoint. We hold our winners, we sell our losers. That's the way it works, okay? Let me just pause for a minute here in the program and see if I got any questions. The way we're handling questions going forward here in season 2 is you guys just ask me anything at any time. We don't have the little stop and start that we did in season 1, so just ask whatever you've got. And I see a few howdies and hellos, so I'm going to wait till there's a more substantive comment that I need to respond to, and I'll just keep going forward, okay? All right. So this is a chart. I don't show charts that often. Some people say there's just too much gobbledygook on the screen, but I'd like to just pause here for a minute. I want you to look at the green line. Okay, the green line is what's called a 20-week moving average. Now, for us to feel good about the market, we want prices to be above that. So when prices are above a moving average, that means there are more buyers than sellers. I know that it feels real bad right now, and especially for those of us in CG, to see that negative for the year here almost at the end of the first quarter. Just as a reminder, it was much more negative than that on this same day last year, okay, because the market low was March 23rd. But you can see here that these 4 bars on the end, we actually have had a lower point than where we are right now, all right? And that was just 2 weeks ago and 3 weeks ago. So this gets back to what I talk about recently on recency bias. Just because something is happening right now and feels very ugly market-wise, that doesn't mean that when you actually look at the data that the sky is falling and we need to bail out and go to all cash and find the nearest 1% CD at our local bank. That's just not the right course of action. Recency bias tells us that emotions that we're feeling right now, and we keep seeing 5 days in a row down, especially after a very strong January and February, we see that and we think, well, that means we've got to get out. That's just not true. And you can see on this chart why that's not. We're still holding these averages. Now, if this low from 3 weeks ago gets taken out, we may well make some adjustments in the portfolios. But right now, there's simply nothing to adjust. And I want to remind you of this very important fact. If you look at this, you'll see IWF. Look at the top yellow bar there, and that means IWF is growth, okay? So what do you see highlighted for March and June? Those look like pretty bad months. Notice that the 12 months are here, January through December, and I've highlighted March and June. For whatever reason, and I don't know the reason, I just know that this is what seasonality is, and the history shows that for growth stocks, in this case technology, communications, and discretionary stock sectors of the 11 sectors, March is just a bad month. And there's just a lot of things happening. Maybe, earnings are running out. There's little to stimuli. People are paying taxes. Who knows what goes on in the mind of the investor? But the data is on the chart. And we're going to probably experience this again in June. We did last year, and I'm just trying to encourage you not to be discouraged. Look at the data at the bottom. In the first month of the year, January, April, July, and October, so that's the first months of the quarter, all right, averages a 2.8% return. In the second month, 3.0. What about the third month? It's actually negative. Well, that should not be a surprise. And remember, last March was an awful month. Now, it did pick up near the end of the month, and of course, we know the story. The March 23rd low became what I think is the definitive low in the current move. I don't see that low ever being revisited again in our lifetimes. All right, but March is just traditionally weak, and we just got to deal with it, okay? That's where you think about Warren Buffett and what he said. So our featured stock for this week is EPAM. I really like EPAM. EPAM is the ticker symbol. It's actually in CG. We bought it at 175.35. Yesterday's closing price, it was up a little bit today, actually 368.58 for an open gain of 110%. Now, I've had a couple people say, how come you always show these stocks that do so well? Don't you ever have losers? Absolutely. We don't hold losers. Okay, we get rid of losers. We cut the loss. We don't get rid of winners and hold losers until they turn around. We cut losers because they're just a psychological drain on you. If I make a mistake, when I make a mistake, we get rid of it. So I feature the stocks that are in here that are what we hope are going to turn into 1, 2, 3, 5, or as Peter Lynch from Fidelity said, 10 baggers. Okay, we've got some really strong performers like Tesla. We bought at 166, reached a high of 900. Okay, it's pulled back from that, but we're still holding it. We're holding it in 2 portfolios because of reasons which I'll show you here. This is EPAM's reasoning, obviously not Tesla's, but they're a U.S. Engineering company. They operate in 30 countries. They provide IT product development, digital platform engineering. So what that means is these guys are involved in setting up online commerce for big entities. And as you know, they're just all kinds of different ideas coming to the market for online presence. And it was continuing in that direction and then just got exacerbated by COVID. So EPAM is very well positioned. And of course, they have product design. Their estimated market potential is $1 trillion. That's what they call the total accessible market, or the TAM. It means that if they look at what they're doing and the total number of customers, obviously if somebody wants to buy ketchup, that's not going to be EPAM. So that total addressable market is about $1 trillion. And that's great because the market cap of this company is only 19 billion, which sounds like a lot, but not compared to the total accessible market. That's why we like them, okay? They have high market multiples, which means they're expensive, but we think it's justified by the rapid growth in revenue. From time to time, I'll have someone say, you're paying a lot for that company. Their earnings per share is high. Their PE ratio is really high. It's like, yeah, so they're making widgets and they're doing great at it. I don't look at that fundamental, I call it sometimes funny-mental data, as strongly as I look at the actual technical performance on the chart. Okay, I think that's really important. All right, next area, economic indicators. These are the things that I look at to make decisions on why we buy and sell. So let me pause just for a moment and look over in the chat and see what I see. Anybody? Hey, Kay, good to see you. Hey, Dr. J, good to see you. Okay, and Hossein, good to see you. I haven't been there in a while. So just as a reminder, to finish that previous section, I'm going to go back to that slide, actually. Let's go back here. So it's not so much EPAM, but since 2000 and 2007, those highs were taken out in April of 2013. The S&P has gained 148% in just 8 years. The three sectors that have crushed the S&P over that time are technology, communication services, and consumer discretionary. Those are my three favorite sectors. Those of you that have watched what we're doing, that are clients, you probably know this. I say it every few weeks on the show. There are 11 sectors in the S&P 500. I could care less about almost half of them. And that's because those sectors just exist and they're paying dividends, and that's great. We have some of those stocks in GI, which is actually the number one performer this year to date. I didn't point that out last time, but I'll cover that in 2 weeks. But these three sectors, guys, have been super strong, and I'm not ready to give up on them. I think they are what is driving this secular bull market in which I believe, and which I continue to think will sustain itself for at least another 7 to 10 years. Okay. All right. So some other tidbits here in the economic indicators, which are not on the slides. Tesla sold 138,000 Tesla Model 3s in China last year. I mean, that's pretty amazing in China. It really is. So what's the portfolio impact of that? We trade Tesla in two portfolios, CG and SG. 90% of all U.S. digital ad markets is based on or at least is, I should say, coming from the tripoly. I never get this right. It's a monopoly with the tri in front of it. Triopoly. There it is. Okay. Facebook, Amazon, and Google. That's up from 80% in 2019. So as the pandemic has accelerated, it's changed consumers' proclivities, I use that word a lot, and how they shop. These are the kind of things that we pay attention to as your portfolio manager, because it's going to change consumer spending. As you well know, GDP is driven by consumer spending, government spending, and corporate spending. But the largest by far, 68%, is consumer spending, at least in the United States. So what's the portfolio impact here? Well, we've owned all three of these companies, Facebook, Amazon, and Google. Only one we have right now is Google. But we've owned all three. We probably will be back in them at some point, but there were better opportunities like EPAM, and that's why we dropped Facebook. We realized there is a regulatory risk to owning these. And obviously, it's not easy to predict this, especially when you're having basically battering questions from Congress to the CEOs of these companies. So But it's an interesting endeavor to follow these policy laws to see how they're going to affect what we're choosing for your portfolios. And that's part of what I really like doing for you guys, okay? Economic indicators. So GDP, we just talked about that. The third estimate. So well, you might say, well, what's third estimates? So the first estimate is in January. That's just a guess. The second one is in February. That's a better guess. And by the third, estimate, it's pretty accurate. And then the same thing repeats: April, May, June, July, August, September, et cetera. Okay. And it was revised to 4.3. Now, granted, this is way back in the fourth quarter of last year, but there is a portfolio impact, and that is because we see that GDP really has a pretty solid chance of hitting 7% this next year, the year we're in right now. Okay. We're expecting this. And I think this is going to strongly increase consumer discretionary spending, helping grow revenues for the companies we own in the consumer discretionary sector. Remember what I just said, we only own a few sectors, meaning 5 right now, 5 of the 11. So it means 6 sectors we don't even have investments in, at least in our growth programs. Okay, let me qualify that. All right, and some of the ETFs we have may have investments within those ETFs, exchange traded funds, but I'm just talking about raw stock buying right now. We're looking at those 3 sectors because those are the 3, as I pointed out just about 10 minutes ago, that have consistently outperformed the S&P 500 since the new bull market began in 2013. Okay, so let's go forward here. This is a kind of an amazing story. So U.S. employers had almost 7 million jobs unfilled at the end of January, according to the Labor Department. That's up from December. Even if all these jobs were filled, there would still be plenty of jobs available in these particular areas. There's a lot of data on this chart, so I'm going to take time and go through this. Lack of skilled labor despite of job openings. Okay, so plumber apprentices. The number of openings is up 24%, all right? And 29% of plumber apprentices, that's how short they are, by 29%. 39% roofer apprentices, even though the jobs available are up by 50%. Openings 33% for carpentry apprentices. I think you get the point here. Full impact, full employment is something that we want to see. Why? Because it means higher GDP. Why do we want higher GDP? Because it means more people spending more money. And who drives GDP in this country? The consumer, 68%. I'm trying real hard here, guys, to show you every bit of data, probably because I'm, following these emails that are coming in, and I want to serve you guys with data that really hits home so you can get off this video when you watch these on Thursday night and think, okay, I know more about A, what's in my portfolio, B, what could be happening, and C, how Charlie's going to adjust his buying and selling for my investments based on the data that I'm seeing. That's the hope of these videos. And I really am going to try to do that for you. Okay. All right. So this is a slide I just added today. Business inflation expectations. These are CEOs that were interviewed by this 3 capital management company. And their point was, they're kind of concerned. Look at the little spike here on inflation expectations. So what this means is the CEOs are going, well, things are going along pretty well. You saw the data on the chart, pretty steady, but we're concerned about these checks that are being issued. Billions and billions of dollars, truthfully, trillions. It's a $1.9 trillion package, although not all of that is going to the U.S. consumer. The real question is this going to stoke inflation? And since I almost monthly get at least one person inquiring about, is inflation going to be an issue? I thought it was important to address. I do not think that inflation is going to be triggered by these stimulus checks, but why don't you guys watch this and make up your own mind?
Millions of Americans are receiving stimulus checks worth up to $1,400 each. You might be one of them. It's all part of President Biden's $1.9 trillion American Rescue Plan.
The American Rescue Plan is already doing what it was designed to do: make a difference in people's everyday lives.
But you might have also heard people say that if all that money gets spent, the economy will overheat and we'll get inflation. In this video, we'll answer the question of whether stimulus checks will lead to inflation. Short answer, it could, but not necessarily. And the reason is that the link between stimulus checks and inflation isn't direct. There's a lot of other things going on at the same time. First of all, not all of the checks are going to be spent. Some people who didn't lose their jobs and are doing pretty well will save the money instead. Put it in their 401k. Or they'll use the money to pay off their credit card bills or other debts. So if that money doesn't get spent, then it won't generate economic activity, and it therefore will not cause any inflation. However, some people will spend the checks, perhaps on new furniture, or a car, or on a trip, or they could use it to pay more for their rent or groceries. And remember, this isn't the only spending going on. There's also billions of dollars being sent out by the federal government as additional unemployment insurance. They're also sending out money for state and local governments. There's money being sent out to help small businesses hold on to or hire workers. Also, people have a lot of savings stored up from last year's stimulus bills as well, and they're just waiting for the virus to end and for businesses to reopen so they can go out and spend that money. And when that happens, businesses will need to go out and hire back a lot of the workers who got laid off last year. So there will be a lot of spending and hiring going on, not just because of the stimulus checks, but for other reasons too. But will that be enough to overheat the economy? Let's step back for a moment and ask how overheating takes place. Inflation happens when the demand for goods and services runs ahead of the economy's capacity to supply those goods and services with its current labor force. Think of the economy's capacity like a container, and demand is like water going into that container. If people go out and spend their stimulus checks, that starts to fill up the container. Businesses go out and hire workers who go out and spend their paychecks, and that also helps to fill the container. But there's millions of workers out of a job, thousands of businesses that are idle. So we could have lots of spending and lots of hiring without the economy running out of capacity or the container filling up with water. Not until the container overflows do you get inflation. Now you may have noticed that the prices for some things are already going up, for airline tickets and gasoline and lumber. And that's not really inflation. Inflation is when most prices are going up, not just a few, and when they're going up year after year. What you're seeing right now are just one-time only price increases in industries that have specific bottlenecks. So right now, the stimulus checks are probably not going to cause inflation. Here's why. Remember what I said about the economy being like a container? Well, the container is still a long way from being full. There are more than 9 million fewer people with jobs now than before the pandemic. It's a lot of slack in the labor market, and it's going to take a lot of spending, a lot of hiring over many, many months before we start to run out of workers. Economists don't really know how much capacity the economy has. It's like they don't know how big the container is. We might run the water long enough to fill the container and discover that the container has stretched and gotten bigger. In other words, we may think we can only get the unemployment rate down to, say, 4%, and then we'll run out of workers. But maybe as unemployment goes down, we'll find a lot more people coming into the labor force to look for jobs. One final point. Inflation is partly psychological. Businesses are more likely to raise prices and wages if they think everyone else will do the same thing. In other words, if they expect higher inflation, they'll act in a way that makes higher inflation more likely. But inflation has been low for years. In fact, it's too low. The Federal Reserve targets 2%, which they think is ideal. Inflation has been so low for so long, people will assume it will stay that way. So I just explained why the stimulus checks aren't likely to produce inflation soon, but maybe in a few years we'll get inflation. How would that happen? Well, if we succeed in vaccinating most of the country, the virus will go away and most of the economy will reopen, so people will start spending again big time. And maybe those stimulus checks won't be the last of the stimulus. President Biden is talking about a big infrastructure package.
It not only creates jobs, but it makes us a hell of a lot more competitive around the world if we have the best infrastructure in the world.
So, in a year or two, unemployment could fall close to 3% for the first time in half a century. That would look like a labor market that has run out of slack, like the container has started to overflow. There's one important reason why we haven't had high inflation in a long time. The Federal Reserve didn't let it happen. As soon as it thought the economy was overheating because unemployment was low, it raised interest rates, and often that put us into a recession. But Jerome Powell, the chairman of the Fed, says this time is different. Because inflation has been below 2% for so long, Powell wants inflation to actually go above 2% for a while. That's why he's keeping interest rates at zero, and that's why he plans to keep them close to zero until 2024 at least.
We're not done, and I'd hate to see us take our eye off the ball before we actually finish the job.
There's another thing that's different. For a long time, all the politicians and the experts said keeping inflation low should be the priority. Not any longer. Now presidents, Congress, and the Fed say low unemployment, especially for disadvantaged groups, is more important. So even if inflation starts to look like a problem, maybe the Fed will be reluctant to raise interest rates. Also, those stimulus checks, that's not really free money. The government borrowed it, and as a result, the national debt is sky high. If the Fed raised interest rates to fight inflation, paying the interest on that debt quickly gets very expensive. So if the Fed ever decides it needs to raise interest rates, there will be a lot of politicians hoping it doesn't, and maybe pressuring it not to.
And speaking of the Fed, Jay Powell, basically, as you saw, there are a couple excerpts from last week, has said we're not going to budge on interest rates. And in fact, let's see here. I got Jay Powell up here somewhere. Here we go. So he remains a dove. So there are 12 members that vote, and he holds the dovish line. Sorry, my mouse is behaving strangely tonight, guys. So holding rates steady till 2023. So the last time that we had a 3% yield on the 10-year, then basically we had a 20% correction in the market. Not something that we want to see, obviously. The thing is that I mentioned last week, a 3% yield on the 10-year is really not very low. It's not very high historically. So we're seeing 5.5%, 6% yield on the 10-year as if you look back, if you remember the chart that I showed you last week, and go back and see that on the video. We think interest rates are very tame right now. I don't expect, and neither did this gentleman from the Wall Street Journal, expect that these stimulus checks are going to cause inflation. And here's the portfolio impact. Lower interest rates are almost always better for investments. Why? Because if you could get a guaranteed 12% in a CD, you probably wouldn't put a nickel in the market, or you'd put a whole lot less than you have when there's no place else to go. Okay? TINA is the acronym. There is no alternative to stocks. And that's certainly the camp that I'm in. Cash is trash is the phrase. That's not mine, but it's one that's used out there. And bonds are risky. I've already given my dissertation on my laceration of bonds and the risk that they are with the very, very low yields. So we're with the Fed on this. I think the low interest rates benefit Americans, and they benefit staying in stocks. The U.S. housing market continues to be strong. It's just great data. So new home sales, which are counted when contracts are signed. All right, so this is different than maybe what you thought, but new home sales are counted when the contract's signed, and they were curtailed last month because of the deep freeze. We had that here in Nashville. They had 7 inches of snow in Nashville, and I guess that was the equivalent of having like 38 in Chicago. But nonetheless, it slowed down real estate activity, and there's 2 reasons that there was a pretty bad month in sales, one of which was the weather, which isn't something that fundamentally affects the market, but the big reason that the slowdown happened is because of the ongoing problem of inventory. All right, let me get back to my inventory slide here. There we go. Okay, so you can see here, minus 30% from 15 years ago. I mean, there's just hardly anyone putting their home on the market. There's a reluctance for people to do this simply because they're staying where they are. And if they're going to stay where they are, then their homes aren't going to come up for sale. Okay. We actually have a family member. I will not mention her, but she's in a large city, and they put their house on the market. I think within 6 hours, they had 6 offers, and they ended up selling their home for 35% over their offering price, which they thought was crazy as an offering price. But there are people out there with money that want to buy homes. And what you're seeing is a seller's market across the country. And I continue to say this, that I've never seen in my lifetime. Is this a healthy thing? Well, it's a healthy thing if you're a seller. It's not a healthy thing if you're a buyer. But the point is, there is economic activity. There is appetite for the largest of the consumer items, which is home. And that's why the housing market is such an important part of what we do in our analysis. And then finally, in the crypto corner, basically, cryptos were created. I've decided on this segment that I'm going to spend more time talking about the crypto market as it relates to the overall economics. When I first started covering cryptos, I showed my trading account and the price of Bitcoin and all that, all of which, by the way, cryptos have had a very bad hair week, not just a day, but very bad hair week. But the point is that cryptos have a future function, I believe, in the economic system. The crypto will become currency, which means the control of that will, in some ways, some regards, go away from the central banks and the central governments. And I believe it will provide a jolt to capitalism because it puts the strength of the exchange of medium, the currency, back in the hands of the individual. That, to me, is the most exciting aspect of crypto. And, you're seeing countries feeling threatened by this. I mentioned last week that India is banning crypto, which is something they just can't do, obviously. But that's what they're trying to do. So they're not the first nation to do it, okay? China, Pakistan, Russia, Bolivia, North Macedonia, Morocco. I'm trying to get these names right here. What do you notice about all of those? Not exactly bastions of capitalism. And they want to ban it because they're threatened. That's the theme that I'm seeing here. And that's why, rather than making a political statement, I'm bringing things to your attention that can affect your portfolio. As these countries try to shut down the cryptocurrency market, which is not going to happen, it's too large, it's going to change our investment decisions and affect where we go and what we look for, especially when you look at a company like Tesla that bought $1.5 billion in crypto, and then you see MasterCard and Visa and JP Morgan saying they're going to integrate it into their business plan. These are all very big positives. So let's just make sure that we understand crypto was created to supplant, that means replace, fiat currencies. That's like the US dollar, the Swiss franc, and the euro. Okay, sovereign nations risk losing control over the medium of exchange if cryptocurrencies become more common as a trusted medium of exchange. The currency risk is real for these countries, I should say. And so, currency risk for portfolios is not something that we discuss all the time. We mostly talk about business risk or balance sheet risk or if the CEO leaves. But currency risk is very real because if we're investing overseas, in England, we obviously, no matter how great the company does, if the British pound loses 25% in the year, our company that we're investing in England, or if it's in Paris and it's the euro, and that drops 25%, that'd be a big move. But if it happened, we have currency risk there. And that sort of thing will play into how crypto integrates into the world medium of exchange. So we watch and trade in-house only. You guys know this that have been watching the program. I do not have any programs that trade cryptos for you clients. And it's because this is just too new and too volatile. But we're watching this as a viable asset class and really excited actually to see where this goes in the future. So our special segment I've been telling you guys about, American energy. We have 5 sources of energy in this country. We're calling this the American Energy Portfolio: fossil, hydro, wind, solar, and nuclear. 80% of this is fossil fuel driven. All right. And so that's what we're going to talk about tonight. And this was my second email from a client. So I'm going to just set this on the screen and go back to full camera here. And I'm going to read this. So one of my clients said, I think you're going to be talking about fossil fuels, and I just want to express some opinions. Now, I'm just going to kind of read some highlights here. But he said, now that the U.S. leader, the U.S. is the leader in natural gas and oil production, we've set the standard for safe, reliable, and affordable energy. America's energy sector supports more than 10 million jobs across the nation, driving nearly $290 billion of capital investment, all while reducing gas emissions. But these new unrealistic energy policies and bans on hydraulic fracking that this new administration has brought in could swiftly undo years of progress and economic growth. He's very concerned about that. Remember that I showed you a video about 5 weeks ago on how the petroleum industry touches our daily lives. And things that you guys remember, it was a short video, but this guy was sitting in his apartment and all of a sudden his TV disappeared and his shirt buttons disappeared and his plastic glass he was drinking from disappeared. Most aspects of our daily lives are touched in some way by natural gas and oil, from the roads we drive on, medicine we take, clothes we wear. If we're going to meet this ever-increasing demand for efficient and cleaner energy, then natural gas has to continue to be part of the solution. And so I want to go back to this slide. You'll see that the number one production of fossil fuel in this country is natural gas, followed by crude oil. Coal is way, way down, and then renewables and nuclear way at the bottom. Now, I'm going to cover the other types of energy in subsequent episodes, but tonight I just want to focus on what's happening in fossil fuels. All right? So just continuing this letter, which I really thought was pretty amazing. They took the time to do this. So banning fracking ignores sound science in favor of a false choice between renewable energy and natural gas. Both can coexist, with 95% of U.S. natural gas and oil wells using fracking, which is mostly up in North Dakota and Montana and Alberta in Canada. But the increase of natural gas consumption, particularly in power generation, has the lowest emissions in a generation. So further, I just think that a ban would reverse our growing energy self-sufficiency. Remember, under President Trump, we did become self-sufficient and the leading exporter of fossil fuels. So I want to thank that reader for sending in that information. I had not planned to have that strong of an opinion on it, but I can certainly see why it would do that. So fossil fuels basically are from the Earth's crust. You guys know that. It's organic material. In 2019, 80% of domestic energy production was from fossil fuels, and 80%, which you can see here, is that number that's been in play now for a couple years. The reality is, though, and this is something I did not know, is that as far back as 1966, the U.S. total energy production from fossil fuel peaked at 93%. So 93% of all our energy in 1966 was fossil fuels. So total fossil fuel production has increased, and it continues to rise, mostly due to fracking. But the production of other non-fossil fuel sources, such as nuclear power and other renewables, has increased. So how does this have a portfolio impact, and why am I covering this? Energy has been a major area of investment for CB3 programs over the past 15 years that we've been doing this. That said, we have very few investments in this energy sector. Remember, it's one of the 11 sectors in the past 2 years because companies in this space have dramatically underperformed tech, discretionary, and communication services. Those are the three sectors you've heard me mention several times tonight. Why am I interested in this? Because I think there's going to be new and innovative ideas happening in energy. I believe it's going to come in the fossil fuel area, certainly in the renewables, hydro, and nuclear. Got a really interesting nuclear section for you in a few weeks. But I just think it's important that we realize that we cannot totally walk away from fossil fuel just overnight. It's not going to work in Texas. Every time there's a major drought or something in California, they shut down, they ration water, they ration power. It's just not something that I think is in America's best interest. So that's it for the energy piece for this week. Investing in post-COVID America is something I had planned to continue, but I just ran out of time tonight. There's so much material, and I really want to get you guys out of here in less than an hour. So we'll pick up this new segment in a couple weeks. So this is what we talked about tonight. If you have questions, please ask them now. I see one from Hossein. What is your assessment on the continuing frosty relationship between the U.S. and China, and how will this affect your investment choices? Great question, Hossein. Thanks for asking that. You guys, while I'm answering this, go ahead and ask questions so that I can get to them. Hossein, that meeting up in Alaska was a disaster. It was a disaster. Obviously, President Trump had a pretty hostile relationship with China, to say the least. I don't know that Joe Biden's going to be significantly different. The real issue that I have with much Chinese investment, we do have FXI, which is an ETF that tracks quite a few Chinese stocks. We have that in our diversified growth program. Basically, it's hard to invest in someone you can't trust. And I don't trust the Chinese. I don't trust their data. At any moment, there could be a major human rights, could there be another march on the square? Their people are not particularly happy. They don't particularly feel free. They are the world's second largest economy, even if you don't trust the data completely. I'm waiting to see what happens with the Biden administration. Certainly, we were not interested in much Chinese investment when Trump was in office. President Trump was in office because of that acrimonious relationship. So it's to be determined. Appreciate the question there, okay? So COVID, we covered the aftermath policy, the interviews with the gentleman from Facebook, Twitter, and Google, the world economy, did the market review, the feature stock EPAM, economic indicators. Obviously, the most interesting one is the inflation counter. Watch that video on that. The Fed holding rates. U.S. housing markets still have a dearth of supply in the housing market. And the Crypto Corner, just trying to educate you guys on the importance of this alternative means of storage of value. And then energy. I'm going to go through each of the 5 sections or segments of the U.S. economy that use the different portfolio elements, if you will, of energy. And we covered the first one tonight, which is fossil fuel. And we'll pick up on the 8th with post-COVID America. Any questions? You guys kind of quiet in the chat box over here. So, all right. Well, I will then at this point move forward and close the way I always do. In summary for tonight, we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. It remains my deeply held belief that we will not only thrive in 2021, but this will be maybe one of America's best years ever. You see the predictions for GDP. The COVID pandemic will be behind us by the end of the year. I feel pretty strongly about that. I feel very strongly about that. There's less political rancor, candidly, even though we have some now. We have plenty. It's not quite as bad as it was, 5 months ago. Maybe that's because one side of the aisle is acquiescing, but this is what we have for a while. Nonetheless, I know that on the seasonality chart, April is a very strong month historically for stocks. I'm looking forward to that. Just checking one more time for questions. But guys, thanks for being part of this. I want you to know that I will take next week off. Passover is Saturday, Palm Sunday is Sunday, and then Easter. So I'm going to take the week off. I'm going to reflect on things. We will be in touch with you, though, because we're going to do a survey. We're going to send you a survey. We want to know what you've seen so far this year. We've had a pretty solid 3 months here of programs, and we want to make sure that we are giving you information and presenting it in a way that is useful to you, that's educational, and I hope a little entertaining, but mainly informs you as to what you hold, or if you're not a client, informs you as to where the strong investment opportunities are in America. Okay, it's real important that we convey that to you. I hope you'll take a few minutes and respond to that survey, okay? Looking for any more questions? Guys, I think that's it. I really appreciate it. Reminding you that at CB3 Financial Group, we don't just manage your assets, we become one of them. And from COVID to U.S. politics to the world economy to clarity. This is CB3 Live. We will see you next time. Bye.